say you didn't have insurance and it's just a huge amount, or especially if you're in a nursing home and you have to pay it out of pocket, you're gonna be able to deduct enough where your expenses go down to almost, not your expenses, your tax goes down to almost zero, so then it would make sense there too. Typically, after retirement, but before receiving Social Security benefits, pensions, or IRA distributions. So this is what happens with a lot, I see this a lot. If you're, say, MDU type company, people have been in that 401k for a long time, so they look at, hey, I'm gonna retire at 60. When should I take Social Security? Well, if you have some savings that's outside of your IRAs, you can use that for some additional funds, because that's already been taxed, right? That doesn't go on your tax return. And then you convert that up to whatever the bucket strategy you want is, and there you are. You keep that up until you do take Social Security. So that's where Social Security comes in. It's sometimes people look at it as, well, I don't know if I'm gonna live to 80, so it makes sense for me to take it right now. It's not only how long you live, it's how much it could impact your taxes. So that's why we throw in, make sure you're paying attention to what you can do for Roth conversions.
Question for you.
Yeah.
If you were to light up Social Security, how would you ever do a Roth conversion?
Can you repeat that?
If you're retired and then you take out Social Security, and you have a high traditional 401k or retirement
Yeah.
pension plan,
Yeah.
how would you ever convert under Social Security years?
It's gonna be hard.
Impossible.
Yeah,
Because
it would
You're
only
gonna lose
make,
your Social Security benefit.
yeah, well, say you're already at 67, so you're not hitting with that $1 for every $2 you earn, so you're past that. But yeah, you still have a nice benefit.
The only way you
So-
could ever possibly do it would be after your normal retirement target.
Correct,
Social
yeah.
Security date.
Yeah, if you retire, yeah, and you are taking Social Security already, yes, you probably want to delay until your full retirement. And even then, it's only if you foresee more income coming from sale of properties, something large, then you could say, okay, it still makes sense to pay this higher tax because it's gonna be even higher 5 years down the road. But yeah, not a lot of opportunity once you start taking the Social Security for the conversions. Yeah, great question. Anybody else have some similar thoughts on that?
Just a question in relation to his, if you have a company that has both a 401k and a Roth 401k, can you take early retirement before your full retirement? Is that 401k Roth attachable to outside monies that you may have?
So it's just like your regular 401k. You can roll it over into a Roth, just like you can roll over a 401k. But no, that's withheld from your paycheck in your 401k, just like your regular. What we prefer is, boy, if you got kids or grandkids, when you're young, crank that puppy up, because when you're in your 20s and 30s, you're just not making as much as you're going to later on. And especially because they do have a lot of those deductions. You might have the kids, you got child tax deductions. So all of us look back, right, and say, oh, if I wouldn't have spent it on this, I'd have dumped more into my 401k or IRA, maxed it all out. But yeah, that Roth, it's so great because I typically would recommend, yeah, you want to get your match in your 401k. That's a no-brainer. You get the company match, but then open up a Roth outside, a Roth IRA, because what does that let you do? You can use your contributions to that. You can pull it out anytime for any reason, your contributions. You just, I decided I did. So that's what I did, even knowing, hey, I might eventually start up a business. Well, all things considered, look at the high interest rates now. So I haven't needed to use it, but it's always, you might as well have that as an option. You don't have to take a loan from your 401k or pay a tax plus the 10% penalty if you have to access it. So there's no reason not to open up a Roth IRA. And then go back and start filling up your 401k again and the Roth 401k if you want. So those totals, you're told you can't contribute the max to your pre-tax and then more to your Roth. It's still the same total. You have to balance how much you want. Right now, if you're over 50, it's $30,000 for this year. So you have to pick how much you want in each one. That's your contribution, not, that doesn't include the companies that can go above that.
And then again, upon lighting up Social Security, does not a Roth IRA sunset,
Sunset.
no longer available?
Yeah, if you can't contribute to an IRA if you don't have earned income.
Right.
Yep. Yeah, then it's too late.
Yep.
Now, if you did the part-time work, yeah, but otherwise selling your investments, selling real estate, yeah, that's not earned income from employment, so that's gone. What's the goal? You must know whether you're trying to keep your income bracket threshold to avoid bumping up into that next highest one, or whether you're trying to increase your income to fill up a bracket to take advantage of that tax rate. So that's this last one we said, hey, maybe you want to do it just to get up to that next one. Other possible approaches. So if you have, there's a number of people, you might have an old whole life policy, and those you can borrow from tax-free. I don't typically recommend those in general, but if you already have one, this is a good time in between there if you're just gonna do some conversions. It's another thing where it's not considered income. So you can consider accessing from there. If you do have highly appreciated stock for low or no capital gains, you might be able to use some of that and not jump into the next tax bracket. Taking distributions from your IRAs or 401ks to take advantage of a lower tax rate. So that's another option if you're past 60 and you have a low income, rather than converting, you could just take out the money right there and put it into, even if you don't even spend it, just put it into your bank account. So it has the same impact. Right, this is one of my favorites. So let's do the qualified business income first, because that's not going to impact as many people. So pre-retirement strategies. If you own a business and it's pretty successful, the QBI now with the Tax Cut and Jobs Act lets you deduct 20% of the income from that business. And there's a way where you can create your own pension if you're a business owner and put a lot of money into that, and then also take the QBI at the same time. If you're looking at that, you probably have an accountant and an advisor, because you need one of them to set this account up. But something more people have is this health savings account. And that one, so health savings account is the best account out there, even for retirement, because it's going in tax-free, it's growing tax-free, and it comes out tax-free. And not only does it do that, but if you're getting it withheld from your paycheck, you're not paying Social Security or Medicare tax on that. That is, still not sure if Congress intended that to be the case. So are there any gotchas on the HSA? There really isn't, because you can keep, say a knee surgery, you can just keep the receipts and reimburse yourself 20 years later. There's no time limit on those. And worst case scenario, you're like, oh, I need that, and I never had enough medical expenses, I need to take it all out. Well, if you're over 65, yeah, you'll be taxed, but there's no penalty. What does that mean it turned into? A 401k. So that's your worst case scenario with an HSA, is that it turned into a taxed on the way out. So I highly encourage people, not everybody can do this, but if you can afford it, or if you're talking to your kids, grandkids, max that out, pay out of pocket. And some people might, well, I don't have enough to do that. Well, even if you need to take and not put as much towards your 401k, I mean, don't miss the match, but reduce your 401k if you need to, put it in the HSA. And most of these companies have great investment options in their HSA. It's not the default. The default is a low interest, but you can open up an investment account in there, and they usually have some great options, including the money market account.
It can be into any investment vehicle,
Yeah,
any investment vehicle.
yeah. The oddly enough, some of my companies, I don't like their 401k investment options because those get, well, I don't want to say political, it's more the companies, they pick funds based more on just, is this great for the employees? I'll leave it at that. But all of a sudden, here comes an HSA, and you look in there, what do they got? They got a bunch of Vanguard index funds and target date retirement funds that have almost no fees. And so I'm asking, why can't we get these in the 401k? These are better in here than they are in the 401k. Not everybody's plan will be the same, but and certainly you probably wouldn't want to plow huge amounts into your HSA if they didn't give you that option. Charitable giving and tax planning. So let's look at Albert and Shirley. 24% tax bracket, they give $5,000 to charity. They have $15,000 existing itemized deductions. Standard deduction now is really large, $30,000. So those numbers you can really forget about them. The only important part there is they have a $5,000 donation. There's no federal tax benefit because you now have to have pretty large itemized before you can itemize. Nobody should, not saying somebody shouldn't give a donation unless they save on taxes, but let's look at what this really means here. So qualified charitable distribution, giving after 70 and a half. So they increased the RMD age from 70 and a half, but they didn't mess with qualified charitable distribution. So you can submit, you can claim up to $100,000 from the IRA per person. It just must go directly to the charity. So don't withdraw it, put it in your checking account, write the checking account to the charity. So what's the benefits of this? It counts as an RMD, but it's not reported as income. There's no deduction on the income tax, but it doesn't come across as income at all. So let's look at how that happens between the two scenarios. Important part, IRA, if you do that to the checking account, to the charity, which is what most people do. So you have $5,000. That does qualify as an RMD. You're taking it out, it's gonna be taxed. It's a 24% tax bracket. So the total cost of that $5,000 deduction for you is $6,200 because you pay taxes on withdrawal. Now let's look at the other option. Charity still gets $5,000. You still have the $5,000 considered an RMD, but the $5,000 is excluded from taxable income, and the tax equals $0. So the total cost is $5,000 minus the $1,200. Huge improvement. And now I think some of these IRAs, maybe some of you have them, I think they'll give you a checkbook where you write it directly from that checkbook from the IRA to, as long as it's a real charity, right? I think some of these have a checkbook that you can write. So can't go from your checking account, but if you're already giving something to charity and you have to take RMDs because you're past 70.5, look into this. Because at the very least, now you can give the charity more money for the same impact on you rather than keeping it with the IRS. Any questions on that? I think it's a little mathy, but. All right, here's some good. So I hope to have assets to pass on to my family. How does retirement tax planning figure in? Okay, organize your assets for your family's benefit. Estate planning still matters. Let's look at why that matters. And we gave a little preview earlier, but so Phil and Mary hold taxable investments in a joint brokerage account. Joint tenants with the right to survivorship. So they have $120,000 in investments with a long-term capital gain. Phil diagnosed with terminal illness, 18 months to live. So you've got a lot more things to worry about than how you arrange your money, but just talk to somebody who this impacted. So this really does, it really can make a difference. And so somebody needs to bring this up to the people who are grieving in advance, like that they have this illness, life-threatening illness. So scenario one is do nothing after that diagnosis, which happens a lot because it feels greasy to anybody to mention, even to the spouse, because they're like, oh, I don't want to bring up money. But if this case, Phil dies, Mary inherits Phil's half of the joint account, right? It just comes over, it doesn't go through probate. And then she gets a step up in basis, but only on his piece, the $60,000. And then if she goes to sell it because she needs some money, she still owes tax on her piece because that didn't get a step up in basis. So she owes tax on her $60,000. Scenario two, after the diagnosis, they move all the accounts into Phil's name, not in a joint, it's Phil's. And he dies 18 months later. She gets the step up in basis with all of that. Inherits it, $120,000, she can sell and pay 0 in taxes. Now, yeah, there can be some things in there if he couldn't have gone on Medicaid, and then, they'd still come for the money. But all other things being equal, you want to move that and get the step up in basis. And you just don't hear people talk about this because who's gonna bring it up? The son, mom and dad, I know you're about to pass away. How about we move that brokerage account over? But that can have a big impact for mom there. So would you rather go sell your investments? When you go to sell, would you rather owe tax on $60,000 of gain or no tax? Here's we're getting to that inheritance piece that I talked about with the Secure Act that has a big impact on taxes and how they're trying to get some of these back, but didn't make the news when they did this last minute when it goes through Congress right before they adjourn right for the year, and everybody's worried, talking about Christmas and New Year's. So Pam, 65 years old, son Kyle, 40. She dies, leaves 100% of her IRA to his son. IRA balance is $400,000. And for purposes of this scenario, let's assume whatever it's saying, it's earning 6% a year. So now, where he used to be able to take that over his life expectancy, now with the Secure Act, you have 10 years. They got rid of the stretch, so takes distributions over 10 years to minimize tax. But he still's got a couple options there, is when he takes it. So if he takes some every year, that would equate to $54,000 that his taxable income is going to increase because he's getting a 6% return, so it's not, not an even amount. However, sometimes you do nothing and then we take that full distribution year 10, well, $716,000, maybe nobody got on it. I don't know unless you have an accountant who's gonna harass you about, hey, you better start taking that out a little bit at a time. And that's gonna put him right in the highest tax bracket. Huge difference. Anybody run into this yet? I mean, they just did the 10, so nobody's gotten to the 10th year yet. But has anybody went to their accountant and been told, hey, we might want to start taking some out right now because we don't know if it makes sense to wait until later. And if not, it's gonna happen soon.
So when does the anniversary date start on that?
Starts accounting to the 10-year.
Yes.
That's a great question. I don't know the answer. I believe it. They don't start it on the exact date of death. I think they do at the end of the year, and then you have till December 31st. So I don't think it starts, say somebody passed away June. I think it doesn't start until January 1st. But I'd have to look.
And you have the whole year to take out for 24. It's
Yeah.
not April 15th deadline.
Yeah, well, in your first years, you don't have to take anything out. Because,
Yeah.
because they haven't said that. So most people, Congress can change stuff at any time, right? So what are people hoping? Well, maybe they'll go back to that stretch IRA and I won't have to take it out at all. And, right, who knows? Just like the RMD finally going up to 75, that could change before we actually get to that point. So that's why a lot of us don't say, oh, it's gonna be 75, we just say it's 73, and then we'll worry about that when it gets here.
So that terminology holds true whether it's an annuity, a traditional IRA.
So annuities are their own thing. There's just so many kinds of annuities. a lot of annuities are life annuities, and then there's nothing after we
Right.
pass away, or there's a 10-year survivor, and then that will just keep going. You know, if there was 8 years left, it'll be paid out. So the insurance companies will keep paying it out, whatever was in the contract, regardless. Yeah, but its own thing. Anybody else on that one? Taxes and long-term care. So, you know, premiums may be deductible at the federal and state level. Payments from policies for reimbursement of long-term care expenses are tax-free. It's actually a pretty good benefit that people aren't aware of. But choosing how to pay for long-term care costs can have a big impact on your heirs. So this one, I hadn't really thought about until a few months ago, but it is a great example because it's not something somebody would think of at first. So let's look at somebody who has a couple options. So they have an IRA, and then they have one of these real popular life long-term care rider policies. Florence qualifies for long-term care benefits now. So she's receiving in-home care costing $60,000 a year. She receives $20,000 a year in Social Security, and she has $400,000 in an IRA. This is a typical case, not unusual. She has a life insurance with a long-term care rider. $500,000 would go to the children upon death, or she can instead use it for up to $10,000 a month of long-term care costs. Most people are like, well, that means long-term care. That's what I'm doing, putting towards the cost. So let's use that scenario. She uses a long-term care policy to pay for it. So she pays little or no income tax during the last 5 years because she has huge medical expenses, so it's going to eat up all that and the deductions. Her long-term care insurance pays the